In this session we're going to look at lifetime transfers. Now here we're talking about gifts or transfers of wealth made by an individual that are not covered by the various exemptions that exist for inheritance tax purposes. So we're going to look at chargeable lifetime transfers or CLTs and potentially exempt transfers or PETs. We'll start with chargeable lifetime transfers. Now, a chargeable lifetime transfer, it is a gift or a transfer of wealth to a trust. Now, a trust, this is a legal arrangement where one or more people, who we refer to as the trustees, hold assets on behalf of another person or other people who are known as the beneficiaries of the trust. Now, trusts can arise from a variety of reasons, but where an individual transfers assets into a trust, then inheritance tax might be paid. First, it might be paid at the date of the transfer. And then, secondly, there might be an additional amount of tax to pay if that individual who made the gift dies within 7 years of the transfer. So let's look at tax that might be payable at the date of a chargeable lifetime transfer. Well, the tax that is payable does depend on whether it's the donee, so the trustees who receive the money that pay the inheritance tax, or if it's the donor, the individual, who opts to pay. So let's look first of all at the situation where the donee, the trustees, agree to pay any income tax that might be payable on a transfer to a trust. What we do is we calculate the gift as follows. First of all, we calculate the value of the gift to the trust in the way that we've discussed in our previous session. Secondly, we'll deduct any available annual exemptions that may exist that could reduce the value of the gift to the trust for inheritance tax purposes. Then we look to see whether the individual has made any previous chargeable lifetime transfers in the 7 years up to the date of that chargeable lifetime transfer. The reason we do this is because if some have been made, then they might use up some or all of the individual's nil rate band for inheritance tax of £325,000. Finally, any amount of the value of the gift that isn't covered by that nil rate band will be charged at 20% inheritance tax. So we'll illustrate this with Kofi, who makes a gift of £400,000 to a trust on 1st of June 2016. Now, Kofi previously made a chargeable lifetime transfer in December 2014 of £200,000, and we're also told that the trustees have agreed to pay the inheritance tax on this transfer. So let's calculate that inheritance tax. We will start with the value of the gift of £400,000, and then we can deduct the annual exemptions that Kofi has, both for the tax year of the gift, 2016-17, and for the previous year, 2015-16. So that's £6,000 in total, leaving a gross chargeable gift of £394,000. And it's that amount that will be subject to inheritance tax. The next step, we need to calculate the nil rate band that's left to Kofi. Well, back in 2014 he made a chargeable lifetime transfer of £200,000. Now that will eat into that nil rate band. But of course, when he made that transfer, he would have been able to set the annual exempt amounts for 2014-15 and 2013-14 against that 200,000. So the gross chargeable gift back in 2014 will have been 194,000. So of our normal nil rate band of 325,000, 194,000 of it has already been used up, leaving 131,000 that will be taxed at 0%. The remainder of that gross chargeable gift of 394,000 will then be taxed at 20%. So that works out at 52,600, and that's the total inheritance tax liability that would be paid on this gift in June 2016. We can, however, have a situation where a chargeable lifetime transfer is made, but it is the donor, the individual who's making the gift to the trust, agrees to pay the inheritance tax. Well, in this situation, not only is the individual's wealth falling by the value of the gift, it is also falling by the value of the inheritance tax on that gift. So what we need to do is we need to gross up the amount of the gift to take this fact into account. The way this is done is by multiplying the amount of the gift that's not covered by an individual's annual exemptions or by their nil rate band by 100 divided by 80. Now this fraction is known to you, we've used it a number of times over the course. Once we've done that, we can then calculate the inheritance tax as normal. So let's have a look at a simple illustration. We have Boutros, who makes a gift of 400,000 to a trust on the 1st of March 2017. Now he's previously made gifts over the nil rate band of 325,000, so there's nothing left there, and there's no annual exempt amounts for the current or previous year. And Boutros has agreed to pay the inheritance tax on this transfer. So we have the value of the gift, that's 400,000, but we need to gross it up. So we multiply that 400,000 by 100 divided by 80, and that gives us 500,000. Now we can calculate the inheritance tax on the transfer, and since the nil rate band has already been used up, all of that 500,000 would be subject to inheritance tax at 20%. So that's £100,000. And that, in a nutshell, is how we would calculate the inheritance tax on this type of transfer. Now there is also inheritance tax that's charged on a chargeable lifetime transfer at the date of death. And that might be payable if the chargeable lifetime transfer was made in the 7 years prior to the date of death. But what we'll do is we'll look at how we calculate that in a separate session. Next, I want to talk about potentially exempt transfers. Now, a potentially exempt transfer is a transfer of wealth or a gift by an individual which is either not exempt under the various exemptions, nor is it a chargeable lifetime transfer. And inheritance tax is charged on these potentially exempt transfers if the individual dies within 7 years of making the gift. So no inheritance tax is charged on a potentially exempt transfer until the date of death is. So for example, if a parent wished to give a child, say, £100,000 in order to help them buy a house, that would be perfectly fine. But if that parent went on to die within 7 years of making that gift, then when we calculate the inheritance tax on death, we'd have to take that gift into account in our calculations. If it's the case that we have a potentially exempt transfer that's made more than 7 years before the death of the individual, then that just drops out of any inheritance tax purposes. We can ignore it. So let's have a look at a very simple illustration. We have Patricia, who makes the following gifts to her children. In 2006, she gave land worth £400,000 to her oldest daughter, and in 2015 she gave £400,000 to her youngest daughter. Now, if Patricia dies in January 2017, then the gift to her oldest daughter is over 7 years. It's been more than 7 years since that gift was made. Then it's going to be excluded from our calculations of Patricia's inheritance tax when she dies. But the gift to the youngest daughter was within 7 years prior to Patricia's death, so that value of the gift is going to be taken into account when Patricia's inheritance tax is calculated.